Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, investors can't seem to escape bad data, even as expectations rise that monetary and fiscal authorities will act soon. Overnight, there were two surveys out taking the temperature of the giant American services sector. The international one found little change from August, but sees it barely expanding. The more widely watched one found the expansion falling back quite sharply, and the gap between the two has narrowed a lot. American analysts have been surprised by the extent of the fall. Those analysts expect non-farm payrolls to rise marginally from the low August result when the data is out tomorrow morning. These expectations are not very high because this would be the third lowest rise since 2017, and those previous lows involved storm disruptions or government shutdowns. This payrolls data has the equity markets awaiting the signal, and the S&P 500 is posting a small gain so far today. In Canada, following up Vancouver's positive housing market recovery, the Toronto realtors say they are also getting the same positive impact, even if the highs of 2016 haven't returned. The European services sector is similar to the American one, now essentially showing a stalled state. And the same survey in Germany was very downbeat, which triggered a sharp sell-off in German equity markets. Last night, the DAX was down 2.8%, a move that wasn't mirrored in other European equity markets. Most other equity markets there were up modestly on the day, although London was lower again. In the UK, there is growing awareness their Brexit recession is now upon them. In Australia, there were two services PMI reports out as well, and both were positive. The internationally connected one was quite upbeat, reporting a rising expansion in September and a good rise in new orders. The local version wasn't quite so upbeat, but it also reported a lift. However, none of this optimism saved their equity markets yesterday, with the ASX 200 dropping an eye-watering 2.2% on the day. Local investors can read the American and European tea leaves as well as anyone, and when China's markets return next week, news from there will almost certainly record a sharp adjustment lower as global trade falls bite everyone. The US Treasury 10-year yield is down another 6 basis points today to 1.53%. Gold has risen further today, up another $7 on top of yesterday's $19 rise, and is now back up to $1,508 an ounce. US oil prices are lower yet again, down to just under $52.50 a barrel. The Brent benchmark is just on $57.50 a barrel. And the Kiwi dollar is firmer today on a tallest dwarf basis, now at 63.1 US cents and up a full half cent. On the cross rates, we're back up to 93.5 Australian cents. Against the euro, we're at 57.4 euro cents. That puts the trade weighted index to just on 68.5 and similar to where we were on Friday last week. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.